Howard, Jorge, welcome. You guys are part of the team that built interest in our bank. Why don't we start talking a little bit about what is interest? What is the concept of interest to start from the basics?
Yeah, we can start there. I think interest is something that's really fundamental to banking. I think when people think about what is a bank account, what do banks do, interest is one of the first things that come to mind. We're mostly going to talk today about the deposit side, i.e. your bank paying interest to you for the money that you hold with them. There's also interest obviously on the loan side of the business, where if you have a loan for a bank, you pay interest to them. But also when we talk about interest, we're talking about effectively a fee either paid to you by your bank or paid to your bank based on the amount of money you've either given them or borrowed. So it's normally a percentage fee, and it's normally paid on a sort of set schedule. Yeah. And like I say, it's pretty fundamental to how banking operates. But strangely, there's not really a lot of rules. There's a lot of conventions, a lot of industry standards, but not a lot of this is how you must implement how interest works. Right. That was quite interesting when we came to, pardon the pun, quite interesting when we came to building it. It's there's a really broad set of open design decisions we have to make.
Don't hold back on the puns.
I'm going to try, but no promises. Okay, cool. And I think it'd be interesting to know I just said the same thing.
Okay, we just have to accept interesting is not a pun. It's just a word. It's fine. Okay.
Why is interest a thing in society? So Jorge, I know you've done a lot on this, and you wrote a blog post about this where you mentioned that interest has been a thing since we were doing barter trade. So why do you think interest has been a thing in society, and how long has it been there for?
So the shortest answer is this thing called time preference, which basically says that in general, we prefer to get things sooner than later. So if I say, I will lend you £100 and you say you'll repay that tomorrow, well, that compared to receiving the money back in a year's time, that's completely different. And then interest is just a way that we have agreed upon in society to put a price on that time between getting the money back tomorrow or getting the money back in a year. You might find other examples of, hey, I prefer to get a hotel or a vacation next month instead of in a year. You don't put interest on that, but the general concept is we prefer to get things sooner than later. And if we're willing to wait, well, we want to get some compensation for that.
Yeah, that's a really good point. Now, Howard, you're a product manager, or you're a software engineer at a new bank, at one of the UK's newest banks.
Are we still the newest? I think we are.
That's a good question.
One of the newest.
Okay, we can definitely say one of, but I think we're the newest. We should know that.
Yeah, I didn't do fact checking before I came in, but that's a good question. One of the newest banks in the UK, and you're presented with this challenge, opportunity, whatever you want to call it, really, but you get to build interest into the core banking system at one of the UK's newest banks. Where do you start?
A tricky place to start. I mean, so like any piece of product development work, you've got to start with the really basic, what is the expectation of the user, of the customer, right? So this is really product design 101 stuff, but what does a user expect to happen? Now, that gets really complicated really quickly when you realize that there are probably 3 or 4 different user groups. So there's the customer that receives the interest, but then we have to think about the needs of our finance colleagues in terms of accounting for and reporting on interest paid. We have to think of our operations colleagues that have to deal with issues related to interest mispayments or miscalculation or payments that didn't come in time to be considered for interest calculation. How do we reconcile that? And suddenly your very simple pay some money to a customer on a regular basis can balloon into endless different use cases and sort of endless different customer journeys. Yeah. But that has to be the starting point. It's sort of what different users are you serving and what different outcomes do you want to deliver for those users? And we sort of fairly quickly isolated three elements of interest, right. And we ended up delivering those as 3 separate projects. And that was rate setting, as the first. So actually
Yeah.
being able to set an interest rate in our platform.
Right.
Then looking at accrual, we'll go, I'm sure, into more detail on that, but
Yeah.
actually calculating how much interest a customer earns.
Okay.
And then finally, interest payment. So when they've earned a certain amount of interest or on a periodic basis, actually paying that interest to the customer.
Yeah.
And those 3 projects all took on a life of their own and all ended up having, again, slightly different user groups, slightly
Yeah.
different considerations.
Because I guess with Griffin's business model as well, it's not as simple as saying there's an, as what we call the nested customer to consider as well, right?
Yeah, absolutely. And the breadth of Griffin's product portfolio as well. So, we offer sort of your more vanilla kind of savings and sort of transactional banking products like operational accounts,
Yeah.
but you also offer client money and safeguarding,
Yeah.
and there are specific regulatory considerations for those products that we need to take into account as well.
Right.
So interest is complex again because we deliberately built it as a standalone capability because it
Yeah.
applies to all bank accounts.
Right.
But there are a lot of different rules we have to consider. And specifically on the nested customer point, we also have to consider what information do our direct customers need about how interest works
Yeah.
to provide to their customers. It's
Yeah.
not enough for us to tell them, but they need to represent their brand and their proposition to their customers. And they
Yeah.
need the tools and the information in order to be able to do that.
This doesn't sound easy.
Going back to building interest, so you said you did it in 3 phases, right? So you had rate setting, interest accrual, and then interest payment. So from both a product management perspective and then also from an engineering perspective, which one was the most difficult or tricky to build?
I'm going to let Jorge answer that first, and then I'm going to share a view.
I mean, I'm sure that all the stages had their own difficult parts because going back to your question as well, as a new bank, we haven't done this before. And as product or engineering members of the company, we're not experts in finance, right? So we had to go back and collaborate with other teams and get in sync and agree on basic definitions. So going back to the calculation, interest is paid on an account. It depends on how much balance you have in that account.
Yeah.
When, all right? So first is, okay, is it the balance at the end of the day at midnight, or is it the balance at 5 p.m. or 3 p.m. or something? Second, when do you multiply? When you multiply by this thing, how do you store the number that you get after that? And the rate setting, of course, is just like put in the number that you're gonna multiply for the balance. But it's not just that, like what number are you going to store, how many decimal places and all that, right? Then you get to the accrual, which of course, by definition, is where most of the computation is. So we haven't defined accrual, but it's basically you want to keep track of how much interest each customer is accumulating on a daily basis, instead of waiting to the end of the month and then asking, tell me the balance for day 1, day 2, day 3, day 4.
That's really interesting.
Because of accrual accounting, right? Without getting into the weeds. But in that process, you're doing basic math. You're saying the balance is 100, the interest rate is 5, 100 times 5. Please correct me if I'm wrong, but it's probably 5, whatever, right? Oh, but it's not 5 per day. It's 5 per year.
Yeah.
And that is an annual percentage rate, which takes into account something called compounding.
Yeah.
And then you have to come up with, okay, if it's 5 per year, how much is it per day? And then give me the balance for that day and whatnot. So from a simple concept of you multiply a balance by a rate, you have to answer a bunch of questions and make a bunch of design decisions that start to become more and more complex. But that's basically it.
So it sounds like accrual is
Yeah,
the
the
tricky one.
short answer is it's accrual. Although I'll add a little bit of nuance to that. So, yeah, if we think about it as sort of input, process, output, the rate setting is the input and the payment is the output. All of the complexity in the processing really sits in accrual. That's where lots of the logic happens.
Right.
There are some really important design decisions, like Jorge said, that we had to make up front about rate setting. So a really basic one that you don't think about until you have to think about it is how many decimal places do we set interest rates to, right? We see, 4% interest, or, bank rate at the moment is 4.75% interest. That's a gross rate, not an AER. But there's nothing that says we couldn't set 4.751%. There's nothing that says we couldn't go to an arbitrary. So we just have to make these sort of very fundamental design decisions early. But ultimately, accrual is where the majority of the complexity lies. I will say one thing, particularly for the Grifflings watching that worked on the rate setting side of things. There was a lot of complexity there in future-proofing interest.
Right.
So when we talk about interest at Griffin, we're talking about our sort of first foray into this, the fundamentals. Interest can be extended in a lot of different ways. Yeah. So we needed to provide extensibility into the future to offer fixed rates for term deposit products, variable and managed rates, rates that are effective for set periods of time, be able to set a rate for a product in the future. All of that complexity we had to, not fully design for from day one, but at least provide some extensibility into that for day one. And so in the future, rate setting will become comparably complex with accrual. But right now, accrual is where a lot of that logic sits, and a lot of where we had to work with, like Jorge was saying, finance and other guilds to really figure out the mechanics and the motions.
Yeah.
So interesting. I've never thought about the fact that interest rate is always 2 decimal places. I've always just been like, oh, that's what it is.
It just is. It just is. And, please write in at home if you can tell me wrong. But I'm not aware of any regulation or any guideline that says it has to be that way. We've really built an industry of convention. Another good example of this is when we were looking at how accrual works. So when you are doing your daily interest accrual, you need to apply a rate to the balance. And how you figure out that rate involves choosing an accrual methodology. And that accrual methodology is pretty simply, how many months do we believe there are in a year? And how many days do we believe there are in a month? Now, again, for those of us that are on the Gregorian calendar, you might say that's pretty obvious, at least, 3 years out of 4. But it turns out there are multiple different conventions that different people use. So one of the more out there ones is what's called 30 over 360, where you just blindly assume that there are 30 days in a month, every month, and there are 360 days in a year. That sounds ridiculous, but the reason for that is that means you pay the same amount of interest every month, regardless of how long that month is.
Yeah.
And these things all wash out over a year. It's more about how you deal with the fact that months and are different lengths, and the year is not a whole total of months. So we ended up using a methodology called actual over 365, which is where we take the actual number of days in the month, which means we pay less interest in February and more interest in October.
Yeah.
And then over 365, which means we assume that there are always 365 days in the year. So we ignore leap years. That actually means we give customers a slightly better deal because we divide by 365, not 366.
That is kind.
It's a lovely thing to do, but it's worth it to save the complexity on our side.
For sure, yeah. That's super interesting. Again, I hadn't thought about how do you manage leap years or February?
So when you ignore leap years, you're still paying out interest on February 29th.
Yes. Yeah.
Right.
Correct. You're just not sort of prorating it per day. So if you think about, we basically pay a 365th of your annual interest every day if you assume your balance is stable. And on a leap year, we do that, but we do it 366 times, not 365. So you end up with 365th more interest than normal, which, again, I'm sure our customers will be very, very happy about. I'm sure they will all notice the difference with that penny in their bank accounts.
Okay. One last one from me before I hand over to Mo. So when you're talking about interest accrual, how do you go about getting the numbers right with interest that's accruing? I think specifically in terms of rounding interest, do you round off how much is accruing every day?
So I think before I let Jorge loose on the fun complexities of rounding, I'll talk a little bit about process here. We found spreadsheets incredibly helpful.
Yes.
And that can be that can be a slightly dirty word in a tech company where we have SaaS tools and we have our own platform and we try and build our own tooling as much as possible. But we had to work with our finance function to make sure that they understood our methodology and that our methodology delivered the numbers that we expected and that they expected.
Right.
And we found that actually using Excel or Google Sheets or whatever as like a prototyping tool to say, here's our balance on day one, here's the accrual, here's our balance on day two, here's the accrual, and do that for sort of a 12-month period was a great way to really quickly test how accurate different methodologies were and where we saw sort of strange edge cases. One of those biggest edge cases being rounding, because fundamentally our platform, our bank has to deal in whole pounds and pence. So we represent everything as, £1 and 1 penny, 1.01 pounds. The moment you start to deal with interest, you have to deal with more accuracy than that. And so then the question is, what do you do with those leftover bits? And that's something that Jorge and a few others spent a lot of time noodling over.
They were not leftover. That's the trick. So yeah, fully agree with the spreadsheets. That's where I was going actually, because first we need to collaborate with finance and make sure that we and product and engineering understand all the definitions and calculations that ultimately, when they load the reports back into the platform, from the platform, they want to see that their numbers are right? And that, of course, depends on the calculations that we do in the back end. And then the basic point of communication between the prototypes on Excel and the code that we have running is that, okay, are they going to do the same kind of math, right? So in Excel, you can say, okay, if you have 0.5, round it up to 1 every time, round it down to 0 every time, or half of the time round it up or down. It's called half even. That was the method that we chose to implement on the platform, partly because of the results that we got from the simulations. In one of the examples, we found that we were missing 1 penny, right? In one of the methods, and on the other one, it was exactly the amount. Let's say, I don't know, it was 1,000 pounds of 5% annual rate, so we would get the 50 pounds, versus the other methods, we would get either 49.99 or overpay, 50.01. And then based on those prototypes and simulations, we agreed that the best method was half to even. But back to your question about accrual specifically, then, even if you use that rounding method, when you decide to pay or accrue the amount for a specific day, what happens if it's more than 2 decimal places? You either truncate the value and forget about the sub pennies, or save it to take it into account the next day. So in Excel as well, we did this exercise and forget about that, and then you end up with a different result. And if you don't truncate, well, you have to decide how many decimal places, right? In school, you probably go to 2, 4, 6 decimals, but beyond that, it becomes unfeasible unless you use a calculator. You can go up to 10 or 20, but in storage and engineering, you have to take into account how much it's going to cost. And then
what was
more
the number
decimal,
that we got to? I want to say it was maybe 24 to be confident.
Something like that.
Something
yes.
like that. Yeah,
Wow.
just a huge number.
Yeah.
But we found a better solution.
Yes, so that's a good teaser. So we have something called the request for comments. So it's part of our design process. We write a document and we specify all the possible options. In this case, the rounding methods, how to define the balance, when to read it, and all that stuff. And then from that process, one of the comments, the feedback comments, was, what if instead of using decimal places, you just keep things as fractions? When you say 5%, you can say 5.00 and the symbol, or you can say 5 over 100. And then on paper, you can write the slash 5 over 100. It turns out that in our programming language, we can do the same. We can say number over another number and not convert it to decimals. So we went back to rate setting and said, let's keep rates expressed as something over 100, then pipe that down to our calculation logic. We had to develop our own functions and stuff to accept those numbers and calculate the rounding and the remainders and all that in fractions. And then instead of having to decide how many decimal places we were going to truncate and store, we just keep the fraction, which mathematically can represent any arbitrary number, right? Except pi. the rationals. The rationals. So,
That's so interesting. So actually using Clojure, that helped. That was a benefit to this exercise by the sounds of it.
yes.
Yeah, that's super interesting. Yeah. From an engineering point of view, where do you start with implementing this? And did it help that we had our own core banking system, our own billing system? Does that help? Like, does that help you experiment and implement this?
Absolutely. So, I mean, if you don't have your own banking system, by definition, your balances live somewhere else,
Right.
right? And because interest is calculated on the balance, if it lives outside of your system, you have to read that from someone else and then tell them, hey, I want to store an accrual transaction.
Yeah.
But because in our case it's in-house, well, we can do it easily by just calling one of our subsystems. What was the other thing? Sorry.
How do you approach implementing this, like from maybe from
Right,
an architecture
right,
perspective?
right,
Or
right.
yeah.
So having the ledger in-house definitely helps because
Yep.
you know what calls to make internally. And if you need to make changes to the ledger, which we did, you can make them yourself as part of the process. Now, how do you go about this? So Howard was signaling to the complexity and multiple parts and all that, even though it's just a simple multiplication. It's not like derivatives or rocket science or anything like that. That's probably just a bunch of multiplications anyways. But
Rocket science is one equation. It's fine.
one equation.
It's
yeah.
called the rocket equation. Look it up.
Yeah. But there's this thing in software engineering called building in layers,
Right.
or stratified design,
Right.
in which you say, okay, instead of building the whole thing as a monolith, you say, okay, give me the lowest level part of the problem, which in a problem like interest, accrual or calculation in general, is multiply the daily rate for the daily balance.
Yeah.
So we built a layer for that. We tested that mostly against the spreadsheets. And then when we agreed that those values were okay, we hard-coded that as tests in the system. And then having that, okay, we know that we can trust the multiplication logic and the calculation of the remainder. And then if you have a bunch of days after the other, that it's taking the remainder from the previous day and all that. And the second layer, we said, okay, now let's plug that into the bank accounts, actually get the balance from the bank account, send it to the calculation logic, get that back, and send them back to the ledger so that it stores. And then the third layer, different things. But basically it was a stratified design methodology, which we write more about in the blog post.
Yeah, that's
So it's
super
like a bottom-up
Yes.
approach, right? Essentially, you start from the bottomest layer and then you're building. on top
You
of
start
that.
from the sort of simplest point, right? So like I was saying, you just take the multiplication, prove that works, and then you sort of add complexity to each side of the thing you're multiplying. And I think from a sort of build perspective, one of the things that's really helpful with that stratified design approach is it really helps the users that we're working with understand how things work. So as part of our development process, we do user acceptance testing. We do walkthroughs with both sort of internal and external customers for new things we're building. And that's just not just interest, that's across everything we do at Griffin. And if we present something fully baked, particularly something that is this sort of nitpicky in terms of the mathematics and the methodology, it's really hard for users to engage with why we've made the decisions we've made. And of course, if they have really important feedback, we've waited right until the end of the process to capture that. So one of the things that we really started doing, I think actually as part of Interest, was the first project that we did this on, was we started doing UATs for user acceptance testing for individual milestones within the project, rather than waiting until the project was complete. So, being sort of, as iterative and as sort of small featured as we can be, really helped us pick out things early in how our operations team want to set interest rates and changing how that's presented, helping finance understand how we get to our accrual methodology and how we, which then gives them enough context that when we present the different options for rounding, they can actually have an opinion that is meaningful and considers why we've made the decisions we've made to get to those options. So I think that's a really important point, that breaking stuff down makes things easier for engineers, but it also makes it easier for everyone else that you're collaborating with as part of project delivery.
Yeah.
Such a basic question. I can't believe we haven't asked this yet. But how long did it take to build Interest?
Never ask an engineer.
Oh,
how long it takes.
we're still going.
I don't know how long it's supposed to take, but I'm sure it took less than whatever it takes in a big, I don't know, banking provider. It's maybe too much praise, but it took like 1 month it was a year ago. 1 month like planning the thing, 10 days writing the RFC.
Okay.
I was
It's very detailed.
I was
Yeah.
new in the company, and I was like, "Oh wow, we
I
get
remember
so
that
much
one.
Yeah.
time,
Yeah.
so much time as an engineer to write the pros." You know, it was like that was pretty cool. That was pretty cool. But overall, like 6 months, I don't know.
Around 6 months, I think. Perhaps interesting context here is that the team that built it. Thank you. The team that built it was brand new. This was our first major project together.
Wow.
So myself and my engineering counterpart Mohit was brand new to the company. I think he joined the December, and we
Right.
kicked off in January.
Yep.
Jorge was new.
4 months, yeah.
Paolo was new.
1 week.
Paolo was a week in. I think Kieran might have joined halfway through.
Possibly. Yeah.
So we were a very, very new team, and we had sort of, I think, 2 really experienced engineers in Sarah and Michael who did a fantastic job bringing the new people kind of up to speed on the Griffin specifics really quickly.
Yeah.
There were 2, I think, kind of major complexities that meant interest took as long as it did. The first I've already mentioned is we planned for that extensibility up front. So that meant that things took a bit longer because we had to do more design work to plan for things like term deposits. That's going to reap benefits this year, next year, etc., as we add complexity on top of it.
Yeah.
The second reason is that we were also designing for commission at the same time.
Interesting.
So we won't go into that detail here, but commission is a different feature, but it shares a lot of the same capabilities as interest. Originally, we'd planned to design those as essentially 2 sides of the same coin, or even commission is sort of a flavor of interest.
Right.
And it actually turned out that added another sort of multiplicative complexity on top of interest, which is already a hairy beast. And so we separated that out entirely. Yeah. And so I think interest plus commission in total took about 9 months,
Right.
with a couple of sort of small projects on the side as part of keeping the bank running, etc. And interest probably took about 6 months at that.
Honestly, you say, "Oh, it took as long as it did," but 6 months isn't that long to
No.
build something
That's what I
so
was hinting at
complex.
the beginning.
Yeah.
No, we could have done it in 2 weeks if we just bought an Oracle system.
I think when you're in it, it feels like this is never ending. And we've been working on it for so long. But in hindsight, 6 months to build a whole interest capability for a bank
Yeah.
is not that long
Which
at all.
hopefully will be around for hundreds of years.
And I think it's come across probably pretty strongly in sort of what we've talked about so far, but a big part of that 6-month process was also sort of diving into and challenging some really fundamental assumptions about how bank accounts work and about how banking works and how our finance system works. And so, yeah, it really touches everything, and it was a really good opportunity to reevaluate some of the sort of fundamental assumptions that we'd made as a business sort of 2-3 years ago. Obviously, as a startup, our business model has gone through some evolution in that time. And so actually a big chunk of the work we're doing this year, whilst it's not directly related to interest per se, was inspired by things we found out about how our platform really works during the process of building interest. So it was also a really great discovery journey.
And
Sorry, go ahead.
there's a couple of things that I would also give credit to on the technical side. We were building on top of the platform that previous engineers built. And because it was robust enough, we didn't have to go and like re-implement balances, like how to process transactions. That was coming from the previous 2 years of engineering work. And the second aspect, non-technical, the culture of collaboration. So there was already a finance tech call scheduled weekly. And there was already relationships between the finance and engineering and product teams that I, as a newcomer, I was surprised to see that, okay, yeah, they talk to each other, they trust each other, because it's not just about sharing methods and, oh yeah, this is how you calculate and you get a document from above. Instead, it's like different teams talking and collaborating together, which is a reflection of the culture that I really like when I joined.
Yeah, I think our finance team can't get enough props for how collaborative they were, not just in the willingness to engage, but also they didn't come with a big rule book of this is how the accounting has to work. It was a truly collaborative approach, and we shaped a lot of how the finance reporting ended up working. And I think that shows the sort of end-to-end, where Griffin is not a back office, middle office, front office business. Everything is end-to-end integrated. So the sort of quote-unquote back office reporting people care deeply about the customer proposition and understanding how their reporting might impact the customer proposition and vice versa. Our commercial people care about the products we sell, having the sort of the right treasury and liquidity management that means that we can continue to run the back office of the bank. And Jorge and I get stuck in the middle on all the fun stuff and keeping those different wires connected.
Yeah, I think you're right. I'm trying to think of other companies that I've worked at where the finance team and then the tech team and the product team are so closely. Do you remember an interesting problem you worked on with the finance team?
So we already talked about it a little bit, but I'll share another anecdote in this, which is rounding. And one of these finance tech calls that Jorge mentioned, we presented different options, and I'll shout out Michael again for presenting some interesting ideas.
I remember that.
Someone once said everyone at Griffin is doing software engineering. Michael is doing computer science, which is unfair to many of our more cerebral engineers. But he presented different options, and one which I thought was fabulous, which we ended up not going with, is this idea of stochastic rounding. So essentially what that meant was every day we would, pay interest, accrue interest for the customer, and obviously there's that leftover bit. And then the question is, what do you do with that leftover bit? Well, you have to store it and figure out what to do with it later. But what if you don't want to store it? Well, it turns out you don't have to, because what you can do is you can write a function that looks at that fractional penny and then basically flips a coin to see whether you convert that fractional penny into a whole penny or not.
Randomly.
But that coin randomly, but it's weighted based on the value of that fractional penny. So if the fraction that's left is, say, 0.75 pennies, then it's 75% chance we're going to pay you a penny, 25% chance we don't. And if it's 0.1 pennies, it's only a 10% chance, and 90% we're not going to pay you that penny. And that had a really nice advantage, which meant that we didn't have to deal with any of the leftovers. We didn't have to store anything. We could just deal with the information as presented on the day. And our wonderful CFO, Chad, said, "That's really cool. That's very interesting. We absolutely can't do it."
Rocket science.
Because one of the really important things for banking, which again, we don't necessarily talk about in these terms, but you really want things to be deterministic and repeatable. You want to be able to explain exactly why something has happened. To comment on like a modern tech trend, we don't have AI anywhere in our core platform, nor do we plan to, because you can't explain why it's done the things it has. And similarly, it would be so difficult to explain to a customer why we had paid them a penny more interest on this day and a penny less interest on that day. But it was a really cool idea to solve a really annoying problem.
I mean, I feel like as a customer, I wouldn't be mad if that's how my interest was being calculated.
Maybe this is the place to bring it now.
And then during this whole project, when you were building interest, I think similar to the question I just asked, but was there a particular aha moment where you were working on a really challenging problem and then all of a sudden you were like, aha, this is how we fix it?
It needs to be the closure ratios once again.
Okay.
So because it sounds simple to just say instead of decimals, keep it as fractions, but most programming languages do not support that. Yes, you can simulate it by storing the numerator and denominator separately, but it's not as nice as having the very data type that you get from the calculation. And I would emphasize that Clojure is a major part of Griffin's identity and culture because both founders are Clojure programmers and they share this kind of philosophy of simplicity and crafted design that we appreciate in languages like this. So it's not just a number type for us. It's like, oh, wow, Clojure can do things that other languages cannot do. So I was really happy with that.
I can see the smile on your face. That is super cool.
Yeah.
Was this a hard project? Was this a hard, as we call them, pitches?
Please don't say no.
That's a really interesting question because I think it prompts, what is a hard pitch? But I think whatever definition you choose, probably the answer here is going to be yes.
Yeah.
The only saving grace was, I think, well, two things. One is we knew it was achievable from day one because it's a prior industry convention. It's an industry standard. It's been done before. We knew that we could get to the outcome. The question was how.
Yeah.
The other saving grace, I think, was that because we had our own platform, because we had our own kind of tech, we knew what the fundamentals were always going to look like. Yeah. So Jorge's mentioned our ledger. Ultimately, an interest accrual is a transaction like any other. Yes. An interest payment is a transaction like any other. So we knew what the building blocks would be from day one in order to put them together, figuring out the values that go into those transactions. Yeah. That's complicated. Yeah. Figuring out how to make sure that interest got paid at the right time or we calculated interest at the right time. There's a lot of design decisions there. Yeah. But ultimately, we knew we had all the building blocks in place. We knew that it had been done before, and we knew that we would get the support we needed from the rest of the organization to go and make it happen. Yeah. And maybe one more thing is the way our product teams are set up. We also knew we would have the time and the focus. Yeah. I think it's so easy for teams to get distracted by something that's urgent but not important or lose sort of sight of objectives. But by maintaining a sort of team focus and team-driven priority set and maintaining those sort of customer or outcome-centric milestones, it was always really clear, what are we trying to do next? Yeah. And when you're on a 6-month project, even if you've broken it into chunks, it can be really easy to get lost. And so keeping those outcomes in mind really, really helped. Yeah. But yes, it was hard.
Well, one thing I remember from back then is not, you can think of something being hard as how much you sweat throughout the process, like how much you have to make an effort to make it happen. But the other sense is what's at stake. Yeah. So it can be easy or hard, but if you get it wrong, how much do you lose? Mm-hmm. Like what's at stake? In the case of interest, basically you're calculating how much you owe people. And then if you calculate it wrong, if it's less, well, that's a problem on the customer side. You owe them money. And if you calculate that it's more, then you're increasing the liability of the bank and make it lose money. So I remember having this in the back of my mind, the numbers need to be right, not just because the tech and the product need to be right, but because of the consequences of getting the numbers wrong. It's not something that you can erase and start back. And we don't need to name companies, but we've heard about a case in the UK that had a bug in the accounting system for a couple of years, and that added up to a large amount. And so how do you go to sleep at night is another way to say it. And I don't want to be on call every day.
Yeah. There was also, I think, another tense moment you've just reminded me of, which is we were obviously in the middle of launching with our first customers while we were building interest. And so we spend some time working through all these different contingency plans for what happens if a customer goes live and puts a bunch of deposits in an interest-bearing account and we haven't built interest yet. And so we had a whole plan for finance and ops to run calculations and reconcile with each other and manually pay the interest out. Wow. And I think, again, that speaks to the organizational focus on customer outcomes and making sure that we achieve the right thing. And a bit of that startup scrappiness where it's like, no bank wants to be the bank that is doing interest by spreadsheet. But if we have to do that for 1 month to make it work, we could have made it work. And again, ops and finance were really kind of coming to the table on that. There was no like, oh, that's not how we do things.
Yeah.
As it was, I think we shipped interest 2 days before our first customer deposit.
Wow.
So that was a tight moment. In fact, it
just worked.
it was even more tight than that because I think we shipped interest accrual 2 days before, and then we had a month to ship interest payment because we didn't pay them until the end of the month. So we were accruing interest in the background, but we had no way of paying them that interest.
We were building the wrong way, and the plane was already like.
Yeah, exactly. It's the Wallace and Gromit bit where Gromit is putting the train tracks out in front of him while riding on the train. That was very much us in sort of the Q2, Q3 last year.
Guys, this has been absolutely fascinating. Thank you so much for sharing all of this, for taking us, as we were calling it before, like behind the build and seeing what it actually takes to build such a like fundamental piece of banking and in technology. So
You're welcome. It's been
really,
super fun.
Really appreciate it.
Yeah, thank you.
Yes.